Hi everybody, welcome back to the channel. Today we're talking about the T word.
Tariffs.
If you haven't already heard, America plans to put a variety of tariffs on a variety of goods, not just on Canada, but on the entire planet. And the number one question I've been getting is, well, what do I do? And while I can't give you a specific plan for your life without a proper fact-finding exercise, I can say this, that while it's important to pause and think things through, eventually, you have to keep moving forward towards your financial plans.
Last year, you spent $5,000 on donuts.
So today, I'm going to share with you 8 practical steps that you can take to protect your finances and stay on track during uncertain times and unforeseen tariffs, potentially, maybe. Number 1, stay properly informed. Information is your best friend. It is often the first line of defense when economic uncertainty hits, whether it's because of tariffs, rising inflation, or fluctuating interest rates. Understanding what's happening and how it impacts you is essential. For example, U.S. tariffs can directly affect jobs in industries like manufacturing and natural resources where more than 2 million Canadians are employed. So here's what you can do. You can stay aware of job market trends. If you work in an industry directly affected by tariffs or global supply chains, you can monitor sector-specific news because the earlier you know about changes, the more time you'll have to make better decisions. But I would even add, check government websites. Stay on top of Bank of Canada and Government of Canada announcements. It's not uncommon for the government to give new grants or tax credits or benefits that can apply to your situation. Tariff tactic number 2, be diversified. One of the biggest mistakes people make is having an investment portfolio that is too concentrated in one sector. Diversification spreads your risk, ensuring that a downturn in one area doesn't wipe out your savings. For example, during the 2008 financial crisis, diversified portfolios recovered much faster than those concentrated in a single sector. Now, you can diversify by asset class, including a mix of equities, bonds, real estate, cash. The exact asset allocation is really going to depend on your comfort with risk and the intended goal for each account. But I would add, don't be random with your investments. Don't just pick a fund or a stock market or a sector because some guy on YouTube told you. Talk to your advisor and discuss with them what it is you're trying to do. Because the goal of diversification is to ensure that your investments are spread out so that no single event derails your financial future. Step number 3 for tariffs, have a budget. In 2023, inflation was hovering around 6%, which is far above the Bank of Canada's target rate of 2%. Most Canadians were feeling the pinch. Rising grocery, gas, and utility prices meant that what worked for your budget last year might not work this year. And look, while inflation has come down, prices have not deflated. A lower inflation rate just means products are getting more expensive slowly instead of quickly. So here's what you can do. You can track your spending. You can use a budget or some sort of a budget app or a simple spreadsheet to understand where your money is going. Because when you know where your money is going, it can help you find where you're spending needlessly or just plain wasting. And I would argue that as you budget, it's better to do a weekly budget than a monthly budget. Monthly budgets allow too many wasteful expenditures to fall through the cracks. So instead of a monthly budget, break down your expenses weekly for more control and more flexibility. Tariff tactic number 4, don't stretch your cash flow too thin. My wife and I actually had to apply this in our own home. We had the option of buying a new van for our family by trading in our older one, but I thought to myself, is this really the time to drain our emergency fund or to take on a lease or to start financing at 7 to 10%? Now, we made the decision to hold on to Old Faithful and not drain our savings. And I'm not saying you should or shouldn't buy a new vehicle if you need to, but if you do, you have to look not just at the cost of the vehicle, but what that will do to your monthly, even weekly cash flow. You should be asking yourself, if I buy this, will I be able to handle a significant financial emergency next month? Now, I understand that things happen and sometimes you have no choice but to go into debt, but I would advise you limit or reduce debt because high interest debt can be debilitating. Carrying a balance on your credit card could cost you hundreds, if not thousands in interest payments every year. Now, there are three main methods for getting rid of debt, and the most popular of the three, and my favorite, which is the debt snowball method, which entails paying off the smallest debt balances first, which in turn give you a quick win and quick motivation to tackle the next debt. Now, there are other tactics like negotiating with lenders or consolidating your debt, and you should really talk to your advisor to see what works best for you. But the faster you reduce your debt, the more money you'll have to invest or save for a rainy day. Tariff tactic number 6, avoid emotional reactions to market volatility. When the market drops, sometimes the knee-jerk reaction is to sell, 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 and cut your losses. But history shows that this is often the worst thing you can do. For example, the S&P TSX Composite Index has recovered from every downturn in history, including the 2008 financial crisis and the 2020 COVID-19 crash. So what do? It's simple. Stick to your long-term plan. Don't let short-term volatility derail your long-term goals. Because here's the truth. There will always be something. Whether it's a housing crisis, a global pandemic, the threat of wars, the threat of tariffs, if you keep abandoning your plan every time the wind blows, you will erode the value of your investments and your savings. Tariff tactic number 7, maintain long-term investment discipline. One of the keys to building wealth is staying consistent with your investment contributions, even when the market is down. Dollar cost averaging or automatic contributions can help reduce the impact of volatility by spreading out your purchases over time. And if you can, try to rebalance. Now, for our clients, depending on the portfolio, we rebalance every quarter. We track performance on a weekly, sometimes even a daily basis. But while we monitor frequently, we always tell clients, and really to anyone who will listen, don't time the market. Trying to predict short-term market movements often leads to missed opportunities. It's not about timing the market, but time in the market. And on that note, in Canada, registered accounts can provide significant tax advantages and/or government investments that can help your savings grow faster. So even if the market takes a dip, maintaining that long-term discipline, especially in Canada, can help you weather the storm and even grow through the storm and keep you on track towards your financial goals. Lastly, tariff tactic number 8, stay committed to your financial plan. A plan is like a roadmap. It keeps you focused on your long-term goals. Economic uncertainty can make it tempting to change course, but staying disciplined is often the best strategy. Now, that's not to say you shouldn't be flexible. Be flexible, but keep moving forward toward those financial goals. By staying committed to your plan, by following these 8 steps, you'll be in a much stronger position to navigate uncertainty, to protect your savings, and build long-term wealth. So keep calm, stay disciplined, and keep moving forward. If this encouraged you or helped you in any way, I'd ask you to like, share, subscribe, and stay tuned for the next video.